Welcome to the deep dive. Today, we're really getting into the stock market. It gets a bad rap sometimes, maybe like a casino, but it's actually, a huge engine for building wealth.
Mm.
Our mission today is to break down exactly how that works.
Yeah, and I think the absolute first thing to grasp is what a stock is. It's not just a number blinking on a screen. You're buying a piece, a fractional ownership in a real
A
business.
real business, right?
Your fortune essentially is tied to how well that business does, its future profits. Companies sell stock, they issue these shares, mainly to get capital, money to grow, launch products, expand, that kind of thing.
And that's the key distinction, isn't it? It's not just betting on a number. You own a piece of something tangible. It's fundamentally different from, say, gambling. It's
Yeah.
more like a partnership.
A partnership.
So, okay, we get what it is. But the big question for, I think, most people listening is, how does owning this tiny piece actually make you money? What are the ways wealth grows here?
Well, there are really two main ways. First, capital appreciation. That's just the stock price going up over time. Second, dividends. That's when the company shares some of its profits directly with you, the shareholder.
Right, dividends. People often think of those as like free money showing up in your account.
Yeah, that's a common misconception. It's not really free money. When a company pays a dividend, its total value actually drops by that exact amount. So the stock price usually opens a bit lower on what's called the ex-dividend date.
Ah, okay, so the value just shifts from the company to your pocket.
Pretty much.
Yeah.
The real return driver is the company being profitable enough consistently to generate those earnings and support the dividend payments in the first place. It's about the business's health.
Got it. So if we want to really boost those returns, make them grow faster, there's this concept people talk about, often called the eighth wonder of the world, compounding.
Ah, yes, compounding. It's powerful stuff. Basically, your returns start earning their own returns. It snowballs. In the stock market, a common way this happens is through DRPs, dividend reinvestment plans.
DRIPs, okay.
Yeah, they automatically take your cash dividends and just buy more shares of the same stock for you. So your ownership stake keeps growing, even if you do nothing else.
And that snowballs.
Exactly.
Yeah.
And then there's what you might call double compounding. This happens with companies sometimes called dividend aristocrats or kings that don't just pay dividends, they increase them consistently year after year.
That sounds like a strong signal.
It often is. It signals financial strength, commitment to shareholders, and it dramatically speeds up your portfolio's growth. It really highlights why time in the market is so much more important than trying to time the market. Time is your best friend here.
So, for most listeners, maybe not wanting to pick individual kings, what's a solid, accessible strategy?
For most people, honestly, the own the market approach is incredibly effective.
Yeah.
We're talking passive index investing.
Like buying an S&P 500 index fund.
Precisely. You aim to just match the performance of a broad market index like the S&P 500. The beauty is you get instant diversification. You own a tiny slice of hundreds of companies. Costs are super low because it's passive. No active manager picking stocks. And it's simple.
Keeps things straightforward.
Yeah. Even Warren Buffett famously recommends a low-cost S&P 500 index fund for the average investor. It's hard to argue with that track record.
Okay, strategy aside, there's another huge piece of this puzzle. Ourselves. Our own psychology. It feels like sometimes we're our own worst enemy when it comes to investing, right? Those cognitive biases.
Oh, absolutely. They can really sabotage you. Two big ones come to mind. Loss aversion, basically. Losing money hurts more than gaining the same amount feels good. So people hang on to losing stocks way too long, hoping they'll come back.
Yeah, hoping against hope sometimes.
Right. And then there's herd mentality. Everyone else is buying. You feel pressure to buy too, often near the peak. Everyone's panicking and selling. You feel you should sell too, often near the bottom. Buy high, sell low, the exact opposite of what you want.
That fear and greed cycle. So what can you actually do about it? How do you fight your own brain?
Well, having a plan helps. A written investment plan. Stick to it. Automate your investments, setting up regular contributions as dollar cost averaging. It takes the emotion out.
Investing the same amount regularly, regardless of market ups and downs.
Exactly. It smooths things out. And patience. Seriously. Remember, time in the market, not timing. And maybe, just maybe, don't check your portfolio every single day. It just invites emotional reactions.
Good advice. Less screen time, more peace of mind. Now, we have to acknowledge risk. Markets go down, bear markets, crashes, they happen. 2008, 2020.
They absolutely happen. It's inevitable. But here's the thing. Historically, looking at the U.S. market long term, it has always recovered and gone on to new highs. Always. Panicking and selling during a downturn. That's how you lock in losses that might have only been temporary.
So don't panic sell. And the main defense against, say, one specific company going bust?
Diversification. Don't put all your eggs in one basket. A simple, globally diversified portfolio is key. Maybe just a few low-cost index funds.
Right.
One for total U.S. stocks, one for international stocks, maybe one for bonds, depending on your risk tolerance.
Keep it simple, keep it broad.
Exactly. So like a quick practical playbook. 1, know your goals, figure out your risk tolerance. 2, open a brokerage account. Low-cost online ones are great. Maybe start with a basic cash account. 3, automate those contributions. 4, check in periodically, maybe once a year. Rebalance if things get way out of whack. That's pretty much it.
So when you boil it all down, getting wealthy in the stock market isn't really about finding some secret stock tip or predicting the next crash, is it?
Not at all. It's more fundamental. It's a mindset shift. You're a partner in actual businesses.
Yeah.
You harness compounding. You're patient.
Right. It's about the long game.
Absolutely. Look, the quote-unquote secret isn't secret. It's just discipline.
Yeah.
It's process over prediction. It's patience over panic. It's consistent habit over chasing quick wins. That's really the core of it.